don't lose money. In this episode, I'm going to address the question, how to weather market downturns. This is extremely important because we are headed for some topsy-turvy markets, and this is nothing new, but I'm going to share with you in this episode how to protect yourself during recessions, market downturns, and actually capitalize on them. Get ready. So my name's Doug Andrew. I've been a financial strategist and a retirement planning specialist now for more than 48 years. I've been very blessed in my career to have authored 12 books thus far, and many of my books talk directly about how to optimize financial assets and minimize taxes, but also how to protect yourself from the negative impact of taxes, inflation, and market volatility. And so I'm going to show you in this episode how you can protect yourself when the market goes down, because I've often described the stock market as sort of like a person with a yo-yo, hopefully walking up some stairs. What do I mean by that? The market goes up and down. We all know that on a daily basis. That's like the yo-yo. But walking upstairs means you hope that in the long run, year after year, that your investments grow. The market is going up. The Dow Jones, the S&P 500 is going to be higher in the long run. That's walking up some stairs. Now, there are periods of time where that person with a yo-yo was not walking upstairs. In fact, for 12 years, that person with a yo-yo, the stock market, was going across a flat surface, meaning at the end of 12 years, the measurement, the S&P 500, the Dow Jones, these are measurements of how the market's gone, was basically where it was 12 years earlier. That's what I mean by a flat surface, and how people doubled and even tripled their money, even though the market did not grow at the end of the day 12 years later. So the first key to protect yourself from market downturns is to get your money out of the market. This is what I did for over 3,000 of my own clients back in 1980. Now, in my various books that I've authored, I tell the story about from 1974 when I started until 1980, I ended up with over 3,000 clients in 13 Western states. And I used to diversify their money in a portfolio of mutual funds, and we were trying to get an average return of 12% back then. Now, we actually were doing a pretty good job. Dalbar, who studies investor behavior, says, if people would just buy and hold and not get involved emotionally with the market, they would average 9.14% with their money in the market based upon 20-year periods of actual history. Now, there's periods where sometimes it's a little higher and a little bit lower, but on the average around 9. Now, if that's in a tax-deferred IRA or 401k, that's not your net because you got to pay tax between federal and state taxes at the end of the day when you take the money out. And so you're netting about 6. So if you earn 9, that means $1 million in a nest egg at retirement should generate $90,000 of income without depleting principal, but you're only netting $60,000 after taxes to buy gas, groceries, prescriptions, and golf green fees. So that's why I employed strategies starting back in 1980 to eliminate the dangers of the taxes, okay? You want to have tax-free strategies. You want to link your returns to the things that inflate, but the third big danger is this market volatility. Wall Street was not built to create predictable cash flow. In fact, Dalbar reveals this. The average investor in the market, especially retirees, the return is 3.49%. Why? If they just bought and held, they could earn 9. It's because Americans watch the market when it starts to go down. And it happened in 2001 and 2003 after 9/11. It happened in 2008. It happened in March of 2020 during the COVID-19 pandemic. The market starts to go down 20, 25, 30%. People go, enough already, and they sell low. That's when institutional investors are buying. Most Americans, they panic and they sell low. And then they wait till the market comes back, and then they buy high. That's the opposite. That's why the average retiree in America only earns 3.5%. That's pretty pathetic. It means on $1 million nest egg, you're only earning $35,000 a year. Do you save $1 million to have $3,000 a month of income? That's pathetic. Let me show you a better way. So my favorite vehicle that allows me to accumulate my money tax-free, and then later on be able to access my money tax-free, and when I die, it ultimately blossoms, it increases in value and transfers tax-free, is what I call the laser fund. Now, laser is an acronym that stands for liquid assets, safely earning returns. And that's why at the end of this episode, I want you to stick with me because I want to gift you a copy of this 300-page book called The Laser Fund, How to Diversify and Create the Foundation for a Tax-Free Retirement. And as I show you what this did during the worst 10-year period, I'm going to even go until 2012, the turn of the century till 2012. The worst 12-year period since the Great Depression, how people doubled to tripled their money. If you're already intrigued and you know somebody who should watch this episode, be sure and share, click like, but subscribe. This is a free channel, of course, and almost on a daily basis, I post a new episode answering a question like this one: how do you protect yourself or weather the market downturns? So here's how. This is the actual market, the S&P 500, the Standard & Poor's 500, from November of 1999, and I'm going to go 12 years out to 2012. This is what we call the Great Recession. And so we had people who had their money in the market. Let's say you had saved your entire lifetime, like many baby boomers had, and you had $1 million at the turn of the century. Now, without adding a dime to this, most Americans, what happened to that $1 million they saved in the market? It dropped in value here by 2003. Many people lost 30, 35, 40, 50%. The average was about 40%. $1 million dropped down to $600,000. It took 4 years to make back what they lost and get back up here to a 9% increase. They had to put off retirement 7 years. They felt like they had lost their future. Now, during this 7-year period, using my favorite vehicle, our clients did not lose when the market went down. They may not have made very much, but they didn't lose. The second the market turned around, they started making money again. Many of them had $2 million at this point, when most Americans barely were back to the $1 million they started with 7 years earlier. This is significant. Then what happened here in 2008? As Warren Buffett put it, he said in 2008, when the tide went out, it revealed who was swimming naked, is what he said. Yeah, in one single year, people lost 40% again in one single year. And it took 4 years to come back to break even to where they finally had $1,046,000 to show for the $1 million they started with 12 years earlier. And that $46,000 wasn't near enough to cover the inflation rate during that 12-year period. During that period, many of our clients were cheering when the market went down because they weren't losing. The first 90 days of 2009, many of our clients locked in gains of 16%, tax-free, after not losing a dime due to market volatility. And at the end of this period, many of them had $2.5, $3 million for the $1 million they started with. Most Americans barely had their $1 million back. Are you intrigued? Now, this comes from one of my favorite vehicles called indexing. Indexed universal life insurance. Universal life is the only vehicle that allows you to accumulate your money tax-free, access your money tax-free, and when you die, whatever's left behind blossoms, increases in value, and transfers tax-free. That's under 3 sections of the Internal Revenue Code that have been grandfathered for over 107 years in the Internal Revenue Code. So here I've superimposed that lost decade, that Great Recession. That was an average of 1/3% annual rate of return. How pathetic is that, having your money in the market? By using indexing, they did not lose. They may not have made very much, but they didn't lose when the market went down. And they made money here, they didn't lose. They ended up with 130% instead of 4.6%. This is using indexing, which is a strategy that I teach. I'll give you a glimpse of how it works. But in a nutshell, back in 1974 when I started, let's say starting the next year, you had $500,000 in the market. In the red, this is what it would have looked like. You know, the 90s were pretty great. And then here is after 2000. At the end of 2010, that 500,000 was worth 5.6 million, and you went through all of these ups and downs, the heartburn. Wouldn't it have been nice that every time the market went down, you didn't lose? You may not have made very much, but you would have ended up here and you would have had 8 million, totally tax-free instead of 5.6. Now, a lot of people say, well, the 5.6 isn't bad. Well, it's not all your money. Most people have their money in the market in IRAs or 401ks. You have to pay tax on that of 1.7 million. You're only netting 3.8. Now, what would you rather have? 3.8 million with a bunch of heartburn, or 8 million tax-free with no heartburn because you never lost when the market turned down. You stayed level, or you made a little bit, but you didn't lose. And as Will Rogers once said, people get more concerned about the return of their money instead of the return on their money when things get bad. So again, if this is intriguing you, I would encourage you to subscribe to this channel, but look at other episodes where I talk about indexing, one of my favorite strategies, and what the laser fund is. But I'll show you how you can claim your free copy of this book. In a nutshell, indexing allows your money to be linked to the market, but your money is not at risk in the market. Your money is safely tucked in a financial institution that's crediting you 4, 5, 6, 7, 8, 9, 10%, whatever their general account portfolio is. But in a year that you feel bullish about America, your money is safe in that institution. This is where banks and credit unions put a lot of your money when you deposit it into them for liquidity and safety, okay? It's the multi-trillion-dollar insurance industry, the backbone of America and the backbone of the world. So you can have your money and just be safely tucked there, earning right now in a low interest environment 4 or 5%. But if I feel bullish about America, my money stays safe and I relinquish the interest. I say take the 4 or 5%. On $1 million, that would be 40 or 50,000 in this example. You don't have to have $1 million in there. You can have 10,000 in there. But you're relinquishing the interest. They buy upside options. And if the market goes up, they will pay you 8, 9, 10, 11%. Do you know that this year that I'm recording this episode, 2021, we've had many people that have locked in gains of 61.33%. We had a client that had 850,000 in March of 2020. We said link, and a year later in March of 2021, they had 1,380,000. They made over 500 grand in one single year, tax-free. But if the market would have gone down, they wouldn't have lost money. But when the market went down in March of 2020 due to COVID-19, our advisors said link, because they knew the chance of it coming back up was great. But if they guessed wrong, they wouldn't have lost their million, okay? They wouldn't have lost their money. They may not have made very much, but because the market went back up again pretty predictably, they locked in gains of 61%. I don't have time in this episode to explain that. Search this channel and find episodes that talk about indexing, because I don't want you to miss out. But if you like to read and learn, I'm going to gift you this book. It's called laserfund.com. It's actually 2 books in one. This side is 200 pages with 14 chapters that has all the charts and graphs and explanations. If you are a right brain learner, you learn more by stories and examples. You flip the book over. You read this one. This is about 100 pages, 12 chapters with 62 chicken soup for the financial soul stories. If you want to use both your right brain and left brain, you read both books, okay? But don't pay $20. I'll gift it to you. Go to laserfund.com, L-A-S-E-R, fund.com. Click on the link below. Contribute a nominal amount towards the shipping and handling. I'll fire out a copy of this book to you, and there's options there to listen and learn, watch and learn. There's even an 18-hour masterclass if you like to do a deep dive. So here is to your brighter future, and you will learn how to weather market downturns and come through them with flying colors.